All right, let's dive right in. Today, Wednesday, February 11, 2026, was a really fascinating day for the global markets. We saw this huge split. I mean, you had the tech sector just blasting off, while the rest of the market was kind of stuck in neutral. So let's unpack the analysis that breaks down exactly what happened.
So this is really the big question of the day, isn't it? The core puzzle we're trying to solve. You have AI stocks just soaring, absolutely flying, while the broader market just stalled out. It's like two completely different worlds. So what gives? This report is all about connecting those dots.
Okay, so to really get a handle on this split, let's start with the closing numbers. They tell a really clear story.
So just look at this, it's pretty wild. You've got the Dow, right? Your big classic industrial companies. And it actually ended the day down a little bit. But then, look over at the Philly Semiconductor Index. That's our proxy for all the big AI chip guys, and it's up over 2.25%. And the S&P 500? Perfectly flat, 0. It's the perfect picture of that tug of war we were talking about.
And you know, this wasn't just happening in the US. It was the exact same story over in Europe. London's FTSE 100 had a great day, a really strong rally, but at the same time, the big markets in France and Germany, both of them ended in the red.
Yeah, this chart just lays it all out, doesn't it? It really highlights what was going on in Europe. The UK's FTSE was getting a huge boost from its energy and mining companies, but Germany's DAX? It was getting dragged down by some pretty specific problems in its industrial sector. You know, things like a big recall at BMW. Totally different stories.
So, that brings us to the big question, what's the real engine driving all this? Well, the analysis points to this massive tug of war between two huge economic forces. And really, this battle is what today was all about.
And this really lays out that conflict perfectly. On one side, you have this incredibly strong jobs report. Way stronger than anyone expected. And that has investors worried about what the Fed's going to do with interest rates. Think of it like economic gravity, pulling the market down. But on the other side, you have the AI innovation surge, just this incredible momentum from soaring chip demand and new tech breakthroughs. It's like a rocket trying to fight that gravity.
And that jobs report wasn't just a little strong, it was a blockbuster. So much so that the market is now betting there's a 94% chance the Fed won't cut rates in March. Now that is a huge swing in expectations, and it's precisely what's putting the brakes on the Dow.
Okay, so you might be thinking, is this tech rally just a big bubble? Well, the report cites analyst Ken Fisher on this, and his take is pretty interesting. He basically says that, yeah, valuations are high, but in the final phase of a bull market, that's not necessarily a warning sign. It can actually be proof of incredibly powerful momentum. And with corporate earnings on a 5-quarter winning streak, you can see there's real substance behind that momentum.
All right, so we've covered the why. Now let's get to the what's next. The report lays out a forecast for how the rest of February might shake out.
So, the thinking here is that this AI momentum is probably going to keep going, pushing the NASDAQ and the S&P 500 higher. But the Dow, it's likely to stay stuck in a range, just turning sideways because of those interest rate fears. Over in Europe, the German DAX is expected to feel more of that downward pressure. But then you look at Asia, and the report is pretty bullish on South Korea's Kospi, expecting it to get a nice lift from that same global demand for semiconductors. Okay, so based on all this, the source material then outlines a potential quant playbook for navigating this kind of market. Now, just to be clear, we're just walking through the report's strategic thinking here for informational purposes. The strategy basically says, lean into what's working. So that's a big 60% chunk in aggressive assets. Think semiconductor ETFs, things like that. Then you balance that out with 30% in defensive assets to kind of steady the ship. And you keep 10% as a hedge, just in case things get chaotic. And this whole thing runs on 3 pretty simple rules. Rule 1, manage your risk. If the market starts getting really choppy, if volatility spikes, the system automatically pulls back on stocks. Rule 2, follow the strong trends. It uses a signal to find which markets have real momentum and just rides that wave. And Rule 3 is really clever. It's a pair trade. Basically, you go long on the AI hardware makers that are winning, and at the same time, you shorten the old-school software companies that are getting left in the dust. It's a way to hedge yourself right inside the tech sector.
So, when you step back from all the numbers and the charts, what's the one big idea here? The report really boils it all down to a single, central theme.
And that theme is this. What we're watching right now is a huge battle. It's the long-term, powerful rocket of AI innovation pushing up against the short-term economic gravity of high interest rates. It's a technology cycle versus a macroeconomic cycle playing out in real time. And so this analysis leaves us with one final massive question. It really is the multi-trillion-dollar question on everyone's mind. In the months ahead, which force is going to win? The incredible momentum of the AI revolution or the powerful pull of economic gravity?